Claiming a tax treaty benefit is one thing. Disclosing it is another. And the penalty for skipping the disclosure applies even when the treaty position you took was completely correct. Form 8833 is called the Treaty-Based Return Position Disclosure. It tells the IRS that you are relying on a tax treaty to change how the Internal Revenue Code would otherwise tax you. It is a disclosure, not a claim form. The treaty benefit exists whether or not you file it. The form is how you put the IRS on notice that you are taking the position. Start with a housekeeping point that matters more than it sounds. The current version of this form is the December 2022 revision. Search for it today, and you will still be handed the December 2013 revision, and university and firm pages still circulate the September 2017 one. Check the revision date before you file. So what counts as a treaty-based return position? You take one when you maintain that a United States treaty overrules or modifies a provision of the Internal Revenue Code, and that this causes, or potentially causes, a reduction of tax on your return. Reduction of tax is the trigger. If the treaty changes nothing about your liability, there is no position to disclose. The regulation, Section 301.6114-1, then splits into two halves, and you have to read both. Subsection B lists positions that specifically require the form. The common ones are these: maintaining that income effectively connected with a United States trade or business is not attributable to a permanent establishment. Maintaining that your residency is determined under a treaty rather than under the code. Positions relying on a non-discrimination article. Positions that reduce the branch profits tax or the tax on the disposition of United States real property. And treaties that alter the source of income or grant a foreign tax credit the code would not allow. Subsection C then waives the requirement for a long list of ordinary situations, and this is why most people who use a treaty never file this form at all. Positions on dependent personal services income, pensions, annuities, and Social Security are waived. So are positions on the income of students, trainees, teachers, artists, and athletes. So are totalization agreement positions. So is a treaty rate on passive income where the beneficial owner is an individual. And if a partnership or trust already disclosed the position, you do not repeat it. Now the penalty. Section 6712 imposes $1,000 on each failure to meet the disclosure requirement and $10,000 in the case of a C corporation. Pay attention to the words each failure. A separate form is required for each position and for each year. So 2 undisclosed positions across 3 years are 6 failures, not 1. Section 6712 also says the penalty is in addition to any other penalty imposed by law. There is relief written into the same section. Under Section 6712 subsection B, the Secretary may waive all or part of the penalty on a showing that there was reasonable cause for the failure and that the taxpayer acted in good faith. Now the part of this form that carries the largest consequence, and it is the part almost nobody mentions. If both the United States and another country treat you as a resident under their own laws, you are a dual resident taxpayer. Where the treaty has a tiebreaker and it makes you a resident of the other country, you can claim benefits as a resident of that country by filing Form 1040-NR with Form 8833 attached. Straightforward enough. But read the instructions under the heading Termination of United States Residency. If you are a dual resident taxpayer and a long-term resident, and you file this form to be treated as a resident of the other country, you will be deemed to have terminated your United States residency status for federal income tax purposes. Because you are terminating that status, you may be subject to tax under Section 877A, and you must file Form 8854. A long-term resident means you held a green card in at least 8 of the last 15 tax years. So a green card holder of long standing, taking what looks like a routine tiebreaker position to reduce a single year of tax, can trigger a deemed termination of residency and land inside the expatriation regime. Nothing on the face of the form announces that. One more thing. A treaty affects how income is taxed. It does not switch off information reporting. Under the regulations, a dual resident taxpayer who elects treaty benefits is still treated as a United States resident for every purpose other than figuring income tax liability, And that is exactly where the reporting duties live. The FBAR is filed under Title 31 and sits outside the income tax code entirely. Form 8938 responds to asset values. Forms 5471 and 3520 respond to ownership and to transactions. Each carries its own penalty regime. That is the pattern worth remembering. The tax answer and the reporting answer are decided separately, and getting the first one right does not settle the second.